I'm not a financial advisor. This is not financial advice. Please do your own research. Welcome to the Vinny G Markets channel, brought to you by Vinny G Money. Now, I know I didn't put out a video this weekend, but I wanted to put one out now. Reason being, these markets are just ripping higher. Within the past 5 days, we have the S&P 500 up 4%, Dow Jones up 3.5%, and the NASDAQ up 4.2%. And with all that going on, our indicators are kind of going crazy too. We have the US 10-year Treasury, and this is running hot at 1.66%. The US dollar index, which has been cooling off at 93.83, and crude oil, which has been running hot, 83.05. So by just looking at our three indicators in a nutshell, 2 out of the 3 are doing what the markets would want to go higher. US dollar index lower, crude oil crushing it higher. That US 10-year Treasury at 1.66%, that could be concerning, and that's what we're going to go over right now. On the Vinny G Markets channel, we've been correlating the US 10-year Treasury to the Federal Reserve's decision on whether or not they're going to taper their asset purchases. And what did we get all last week in the news? Fed policymakers hone in on November taper timeline. 3 US Federal Reserve policymakers on Tuesday said the economy has healed enough for the central bank to begin withdrawing its crisis-era support. Also, an article on October 12th, Fed Bullard says bond purchases should be tapered quickly in case rate hikes are needed. So this guy's actually even talking about rate hikes. And also the following day, October 13th, Fed lays out plan to reduce bond purchases, flag inflation worries. Federal Reserve signaled on Wednesday it could start reducing its crisis-era support for the U.S. economy by the middle of next month, with a growing number of its policymakers worried that high inflation could persist longer than previously thought. Now, what's interesting about all this is based off those Federal Reserve statements, we would have thought the U.S. 10-year Treasury would have rose right then and there. But let's take a look. From October 12th to about October 15th, we see the US 10-year Treasury went from 1.6 to about 1.5. It actually dropped significantly. And we'll go over this later, but that's actually around the time we sold some more puts, because when that US 10-year Treasury drops, the market usually likes that, which we did see, because from October 13th, that's when the market started ripping higher. And of course, this is all speculation, but it could have meant that the street just doesn't believe the Federal Reserve is going to reduce their asset purchases. This came out on Thursday on the 14th. New York Fed official giving no fresh taper plan details, says central bank remains focused on flexible and adaptable implementation of policy without offering any fresh details about the central bank's forthcoming plans to taper monthly bond purchases. So with words like flexible and adaptive, that's the Federal Reserve just trying to confuse people and confuse the markets. Because if we take a look when they were buying assets back in December 2020, take a look at the language that the Federal Reserve uses. It says the Fed delivered in that respect, saying it will continue to buy at least 120 billion of bonds each month. Now, it's that word "at least" that would be throwing me off, because the Federal Reserve, their next meeting is in November. They could come out in November saying they're going to taper. So hypothetically, let's say they decrease their purchases to 100 billion per month. But if they use the word "at least," listen to what it sounds like. We're going to buy at least $100 billion worth of asset purchases. That means they just have to buy at a minimum 100 billion. They could still go over if they want, the same way they could still go over the 120 if they want right now. So let's say they're buying 150 billion. We would never know, and because they're using the word "at least," they could change the verbiage to whatever number they want, but as long as the word "at least" is in there, they could buy whatever they want anyway. So that could make the street not believe the Federal Reserve, especially when they come out saying that their policies could be flexible and adaptable. It tells you not to trust them, because they could change whatever policy they have anytime anyway. But from October 15th on Friday to present day, that's when we see the US 10-year Treasury really going higher, as we pulled up 1.66%. That's running very hot. But I did pull up a pretty good article when it goes into the US 10-year Treasury and bond yields. It says Treasuries acting like meme stocks help explain the low bond yield rates. I'm not going to go too much into detail in this article, because one, I don't fully understand it, and two, I'm just going to post the link so you could read it at your own pace. But this is basically saying that the yields, like we've been saying on this channel, are ultimately low because of the balloon and balance sheet by the Federal Reserve. It has has a cool chart on here. It shows the amount of treasuries held by the Federal Reserve, which they've surged since 2019. And I wanted to pull this up because I didn't even realize this. The Federal Reserve, they actually started purchasing US treasuries back in 2019 prior to any type of pandemic. And we see that here, this article reported it on October 11, 2019. Fed launches treasury bill, buys in bid for ample reserves. The Federal Reserve said on Friday that it will start buying about, there's that, vague word, about at least $60 billion per month in treasury bills to ensure ample reserves in the banking system, but emphasized the new program does not mark a change in monetary policy. Also in this article, it says they plan to have this go into the second quarter of 2020, but going into the future, we know what caused the Federal Reserve to continue buying assets at an uncontrollable rate. Whether they knew that was going to happen or not, you could decide that for yourself. But going back to the Bloomberg article comparing treasury bonds to meme stocks, we see that also that it's the US banks that have been buying US treasuries like crazy as well. Purchases of treasury securities by America's biggest banks have surged. You could even see with them from this chart from about 2019 forward, just like the Federal Reserve, they've been buying US treasuries, and all this is going to push the yield rates down, which is basically what I think everybody wants, because that makes money cheaper to borrow. And if you've been following the Vinny G Markets channel, you know that it's cheap United States debt that's keeping everything afloat right now, not actual economic growth, which we're gonna go over later in this video. But in this article, it's comparing US treasuries to meme stocks, cause like in meme stocks, it's just the amount of people that are purchasing the stock, nothing about fundamentally those companies, but just the amount of purchases that are pouring in that's driving those stock prices higher. It's the same thing, the amount of purchases that are going into US treasuries is driving the actual price of those treasuries higher, but bringing the overall yields down. And at the end of this article, we see that it says we may not have a time when the Fed is not involved in the treasury market during our lifetimes. Again, that's pure speculation, but you do have to understand we did start this treasury buying back in 2019 before any pandemic. So who knows, the Federal Reserve could continue to buy assets even if they say they're going to taper, and even if they do implement some type of taper, they're still buying assets at levels we've never seen in our lifetimes. But with that US 10-year treasury currently hot at 1.66, I would be extra cautious right now. I still wouldn't expect any type of big market crash, so I wouldn't scale off of any long-term investments. And when it comes to short-term, we've been waiting for pullbacks to sell some more puts, and that's what we did this prior week. Again, this is all paper trading, but we sold Facebook puts with a $300 strike price with a 10/22 expiration, and we sold Visa puts at a $205 strike price with a 10/22 expiration. Both expirations are on this Friday. We did that on October 11th, and on October 13th we sold Facebook puts at a $295 strike price with a 10/29 expiration, and we sold Goldman Sachs puts at a $340 strike price with a 10/29 expiration. So that's in 2 weeks. We'll wait for a pullback to see if we want to sell more puts this week, but we're going to see what the market does with that US 10-year treasury high. But what's helping the market is with the US 10-year treasury going that high, the US dollar index has actually been decreasing. We see the US dollar index, it's at 93.83, and our big hitter crude oil big time at 83.05. And what we say about crude oil, that brings the energy sector up and the financial sector up, and that usually brings the rest of the market up as well. And before we get into crude oil, I just wanted to go over the puts that we sold in last week's video. Microsoft, $275 strike price, expired 10/15, worthless. We kept the premium on those. And Goldman Sachs puts we sold, $335 strike price, expiration 10/15. Those as well expired worthless. We kept the premium on those. Both of those are winners. So short term, we were good on both of those. And as we go over crude oil this week, we see crude oil up big time at 83.05. We see Saudi energy minister dismisses calls for extra OPEC barrels. So OPEC leader Saudi Arabia dismissed calls for speedier oil output increases on Thursday, saying that their efforts are enough. And also on Monday, we have OPEC misses crude output targets, strain in global oil supply. So what they did agree upon to pump, they didn't even pump that much. So you see that the strain on crude oil is continuing. I remain very bullish on crude oil. Nothing changes over here. And the rise in prices of crude oil brings us right into inflation. From cars to gasoline, surge in prices matched a 13-year high. Another jump in consumer prices in September sent inflation up 5.4% from where it was a year ago, matching the largest increase since 2008 as tangled global supply lines continue to wreak havoc. And we have U.S. wholesale prices rose record 8.6% over 12 months. Inflation at the wholesale level rose 8.6% in September compared to a year ago, the largest advance since the 12-month change was first calculated in 2010. Also, the price of cotton just hit a 10-year high. We went over the last video. The CEO of Levi Strauss already said that's going to be passed along to the consumer. I'm sure other clothing retailers have the same plan as well. Kraft Heinz CEO says inflation is across the board. People need to get used to higher prices. Thanks a lot. Consumers need to prepare for a permanent increase in food prices, according to the Kraft Heinz CEO. Also, Procter & Gamble combats inflation with price hikes in most categories. It says Procter & Gamble is set to raise prices across the board to combat broad-based and sustained inflationary pressure. Procter & Gamble has announced price increases in 9 out of 10 product categories, and Procter & Gamble just had their earnings released and they topped estimates. How they do it with price hikes, helped offset some costs, warns more inflation ahead. And when it comes to energy, we have U.S. household winter heating costs to see double-digit growth according to the EIA. The Energy Information Administration has warned that cost of heating oil is expected to rise approximately 43% compared to last year due to higher expected fuel costs as well as more consumption of energy due to a colder winter. And with all that said, we have retail sales unexpectedly rise in September as consumers keep spending. Some people are going to view this, and the mainstream media is going to view this as a good thing, that consumer confidence is up, that it was people going back to school, this and that. But the Vinny G Markets channel is going to give you the truth, and the truth is that people are just going out there spending because they know the purchasing power of the US dollar is decreasing every day as inflationary pressures just keep rising. They're going out buying whatever they can, even hoarding, because they know those items that they're buying, it's just going to become more expensive over time. And that's why I'm not going to pull up the pictures or articles, but a lot of these stores, their shelves are empty because of this, and it's only going to get worse as we go into the Christmas season. But this also could be viewed as very bullish for the stock market because earnings are going to go up, people are buying their products. And plus too, what's the best way to protect your money against inflation? It is the stock market. So again, we'll just continue to monitor this stuff as well, because none of these increased sales have to actually do with economic growth. We see the IMF, International Monetary Fund, you could look them up if you need to, they're kind of a big deal, but IMF cuts its global growth forecast, citing supply disruptions and the pandemic. We also have Goldman Sachs cut forecasts for U.S. economic growth in 2021 and 2022. We also have Goldman Sachs chief economist warns substantial slowdown looms over the U.S. economy next year. And we have U.S. consumer sentiment falls to second lowest since 2011. U.S. consumer sentiment fell unexpectedly in early October to the second lowest level since 2011 as Americans grew more concerned about both current conditions and the economic outlook. And when it comes to unemployment, that number actually did get a little better. It says jobless claims fall below 300,000 for the first time since the pandemic began, but it's still 293,000 more people this week going on unemployment benefits. Along with this, we have a record 4.3 million workers quit their jobs in August, led by food and retail industries, and we're starting to see this. More people are just quitting their jobs. Reason being is when the whole economic shutdown happened, people got used to staying at home. It became a habit. Nobody wants to go back to work, so we're gonna see this more people just quitting, thinking that they have enough in their savings to survive, and eventually we're gonna go on universal basic income anyway. That's gonna be the solution, because by the time people wake up, it's gonna be too late. The robots, drones, algorithm, AI, they're gonna take over the jobs anyway. And the Federal Reserve is telling us that this is a problem. We have Fed President Balkin says U.S. labor supply problems may outlast pandemic. U.S. labor shortages may outlast the C-word pandemic and limit overall economic growth unless the country comes up with better education, health, health and childcare policies to boost the number of people willing and able to work. Yeah, good luck with that. And we have Fed's Bowman says U.S. labor market could struggle to return to pre-pandemic levels. The obstacles making it difficult for many women to work, combined with increased retirements, could hinder the labor market recovery and be a drag on the U.S. economy. So the million-dollar question is this enough for the Federal Reserve to begin tapering? And if so, how much? We know that the first time jobless claim numbers just clocked in below 300,000, so that's getting better. But at the same time, the Federal Reserve is telling you it knows there's a problem in the labor market with people just not wanting to work, and that's going to drag the U.S. economy down. And on the Vinny G Markets channel, you know we focus on investing in the fourth industrial revolution and the technology in that, because we know that technology is going to be the answer to the labor shortage problem. And what's Goldman Sachs doing? Goldman is doubling down on technology investing. Goldman Sachs Group investment banking co-head Dan Dees said the firm's deal makers are looking for opportunities in all areas of technology as companies emerge from the pandemic era. AI, augmented reality, quantum computing, synthetic biology are among areas for investments. We're doubling down on everything in technology right now. Dees said it's such an exciting time. And also Goldman Sachs says oil prices could be higher for much longer. I'm starting to think that Goldman Sachs watches the Vinny G Markets channel, and I couldn't blame them if they did. And just a couple interesting things when it comes to real estate. Foreclosures are shooting up. The number of properties with foreclosure filings shot up a whopping 68% in the third quarter of 2021. And also, U.S. housing starts fell last month, led by multifamily slowdown. U.S. housing starts decreased in September, driven by a pullback in multifamily construction as lingering supply chain constraints, shortages of skilled labor, and elevated material costs continue to challenge builders. And neither of those pieces are good for the U.S. economy, but we'll take a look at the Federal Reserve reverse repos. We see last week they were around that 1.3 trillion. Into this week, they got to 1.4 trillion. So you see there's still plenty of liquidity in the system. Banks got nowhere to put the money, so they use the reverse repos. When it comes to the crypto market, we see that Bitcoin is up big. It was up over 64,000. If we take a look at Tether, we see that Tether did pump a little bit. It's now over to 69 billion. Grayscale, we see them continually make purchases. We left off at 48 billion. They're now currently at 54 billion. That's about 6 billion in purchases since our last video, so that should have told us something was up, even though the back contracts expired last week. But it's not the entire crypto market. We see Bitcoin dominance is making a comeback, so a lot of those gains did just go into Bitcoin. A lot of the other altcoins, they didn't really move like that. Some of them did, but it was mostly in Bitcoin. And reason for that is the first Bitcoin futures ETF debuted Tuesday on the New York Stock Exchange. People are very excited about this, but let me explain. This futures ETF has nothing to do with owning actual Bitcoin. It's just betting on the price of Bitcoin. So people hopping into this, or most people, they're just betting on the price. This is just opening up the casino even more when it comes to crypto. They're just looking for price swings, whether it's up or down. They're gonna make money on the futures contract, and to me it's not a coincidence this is happening at the same time that the Federal Reserve might start tapering. Because we know it's the Federal Reserve that's been pumping this crypto market up in the first place, they now just created another investment vehicle where they could easily short this market and make tons of money if the crypto market takes one of those 80% corrections, which if the Federal Reserve starts tapering, believe me, it can happen. It won't happen overnight, but if there is a bear market, trust me, a lot of money is going to be made through this Bitcoin ETF, and that's the reason why it was put in place, not to actually invest in Bitcoin. So just please keep that in mind when it comes to this. I know we're reaching record highs right now and can reach more record highs, especially when it comes to open interest, but when it comes to downturns and bear markets with this ETF, it could amplify that, where the corrections could be even bigger, because again, these investors, they don't only make money when it goes up, but they're going to make money when it goes down too, and that's all this ETF is. It's just opening up the casino to big investors. So you see, when it comes to the Vinny G Markets channel, we're covering everything. We're keeping our ear to the street. We corporate hustling. So if you like what you hear, Hulk smash that like button. And as always, I'll leave you off with this. The God of the Bible, the God of Abraham, the Father of our Lord and Savior Jesus Christ is real, and may he bless you.
Lots of questioners want to know whether you share Congressman Ron Paul's skepticism of the Fed. And I'm going to quote you. This isn't in Basic Economics, but a recent column. Quote, "For most of the history of this country, there was no Federal Reserve System." There you go, that dirty trick of bringing in history.
Oh, yes.
There was no Federal Reserve System, which was established in 1914 to prevent bank failures. But bank failures in the 1930s exceeded anything ever seen before the Fed was established. Close quote. If we could make you dictator, would you abolish the Fed?
Yes.
You would.
Yes, I mean, for the reasons I just gave, the history. There's no, the Fed represented wonderful hopes, but we've had so many programs that represented wonderful hopes that ended in disaster. I don't doubt that someone who is sufficiently scholarly could come up with examples of where the Federal Reserve made things better. But the question is, overall, what was it supposed to do? It was supposed to do not only prevent bank failures, it was supposed to prevent huge changes in the money supply, in particular, great deflations.
Right.
The greatest deflation in American history occurred under the Federal Reserve System. There was a crisis in 1907. J.P. Morgan, the original J.P. Morgan, called the other bankers into a room, supposedly locked the doors, and said, "We got to do something, or we're going to all collapse." And they did something, and they didn't all collapse. But the progressives were shocked that one man could come in and take command of the situation, and especially someone who wasn't even in the government.
Right. So what would you do? You'd move us back to the gold standard, or you'd let banks issue their own currencies the way they did up through the Civil War? Say I could.
Well, they weren't doing any of those things as the time the Federal Reserve was created. We were on the gold standard, though. But whether we're on or off the gold standard, that's another whole set of arguments. There's no evidence that I can see that over this vast period of time that the Federal Reserve has existed, that things on the whole have been better. The great post-World War II inflation was fed by the Federal Reserve doing exactly what they're planning to do now, namely buying up the bonds issued by the Treasury.
But don't you have, I have to say, I wasn't expecting your answer to run in this direction, so I don't have follow-up questions prepared, or I may actually have to think here in real time. But don't we have the example of that period from 83 through a couple of years ago, that 25 years of economic expansion? We had only two downturns. They were both very shallow and very brief, and what you had was Paul Volcker, whom Carter appointed, but Reagan gave the freedom actually to wring inflation out of the currency. He did that by the mid-'80s. The economy takes off. Alan Greenspan does a reasonably good job, and then at the end, there's too much money but maybe 5 years of getting it wrong. So
what Volcker did was undo the harm that previous Federal Reserves had done.
Including Arthur Burns.
Yeah, unfortunately, who was my teacher and whom I much admired.
Right. So, but what would you replace it with? How would the currency? How would the currency run?
We would replace it. We could replace it with what existed when it was created,
which was the gold standard.
Well, maybe the gold standard, but maybe not. But there's no evidence that what would you replace it? Things always bother me.
They do?
When someone removes a cancer, what do you replace it with?